Okay, it's 4 o'clock, so let's get going. Thanks for coming on this sunny July Wednesday. And also most welcome to those of you who are either watching or listening in over the telephone, wherever you happen to be in the world. Marianne Sinn and myself will go through the main arguments about Swedish monetary policy presently, and Marianne will also say a few words about how we look at the kind of analysis that we make given the conditions in the world, particularly around us. So this time, monetary policy report, a full report with lots of things, but so we can only do the main arguments. And this time around, the conclusion that we came to was that given that we have to weigh what's going on in the Swedish economy against what's going on in the rest of the world, and that's both the global economy and what is going on in Europe, the most suitable way of going forward was to leave the repo rate unchanged and then change the interest rate path a little bit. And we have many different forces here, but two of them that are obvious is that on the one hand, the numbers have come in a bit better domestically, while on the other hand, things continue in Europe in one way pretty much according to what we have said in April and actually a number of times before that. It's been sort of 2 steps forward and 1 step back, and then this keeps going and going, but at least regardless of how it unfolds on a country by country basis, it's going to go on for some time. It will be uneven. It differs from country to country. Eventually, Europe will get out of it, and the EMU will get out of its difficulties, but it will take time, and that, of course, weighs down on the Swedish economy. And as given your background, you are well aware. There's one way of describing what is going on. Long rates have been going up in Spain and Italy, and in the other direction in Germany. And if we were to put in a Swedish graph here, it would be fairly similar to the German one. So another way of looking at this, or another way of describing what's going on here, is to say that technically we tend to talk about the EMU and the rest of Europe, but another version of the whole of this would be to describe it not so much in EMU terms, but more in terms of Southern Europe and Northern Europe, and that is something that matters to us, in the sense that Northern Europe is developing better and growing at a quicker pace than Southern Europe, and that of course affects us in a positive way. And one way of depicting this is to look at the graph for Norway and Germany, and as you can see, particularly the Norwegian one is of course very much on the positive side. Germany is also above zero, but then on the other hand, you have Italy and Spain that weighs down on the EMU countries. Now, in our case, given that we export an awful lot more to Germany and Norway than we do to Spain and Italy, this is, of course, something that affects us favorably. And so far, looking at the rest of the world, if you start with global growth is hovering around 4%, and there's nothing much dramatic about that. And that's, of course, something that is also to our advantage, given that exports to other parts of the world have been growing over the past years. In the U.S., growth is getting back to something that we are used to recognizing, looking at the blue graph, and this is setting aside the domestic discussion about the budget deficit and a whole bunch of other things in the U.S. But in terms of the growth numbers, they are reasonable. And then we have the EMU, the euro area, which is going to go through a bad year this year, and that's very much, of course, what the conversation and what the debate is about in Europe presently. But still, given our position in the world, it's to our advantage that we're not so dependent on what's going on in southern Europe. And this then translates into continued growth in the Swedish economy, and this is despite the problems in other parts of Europe. And as you can see here, looking at the July, the red graph there, and the projection plus the numbers that came in earlier this year, kind of evens out that on the one hand the numbers were better early in the year. Now we are slightly below the projection that we came up with in April. But all in all, as you can see there, we're only talking about minor changes here, and basically this is done on the expectation that growth gradually will return to something more normal, something that we're used to recognizing. And in that sense, one can argue just looking at this graph, the way it looks, that we have the worst in growth terms behind us. And also confidence among households and companies has dampened slightly, but it still hovers around 100, and that's in some sense also a good sign. We'll see, and time will tell, of course, where this will go. But if you look at the gyrations that we have had in the past few years, there's nothing kind of remarkable about this, and this very much also, I think, reflects what we have seen earlier this year. And when then this translates into what has been going on and what we expect to go on in the labor market, the numbers have actually come in a bit better than we expected them to come in. And that's, of course, a nice thing, given that growth will be low this year. It's not that surprising that unemployment goes up a bit and then gradually goes down again once growth picks up in the Swedish economy. And then what also matters to us is when you look at this is cost pressure, and given the wage negotiations that have been going on, and given that we come from an environment with fairly low wage increases, on the one hand the cost pressure will go up, but on the other hand it kind of is within those boundaries that we would like to see in order to ensure that inflation stays stable. And this is also exactly what one would expect when growth comes back in the economy and when unemployment slowly falls. So, but this is also something that, of course, matters when it comes to translating this into inflation numbers. And that's what you get. Then we have low inflation presently, but as far as we can judge, inflation will be rising. Looking at CPI-F, we're going to move towards 2%. And then given that is the case, and given that we don't want overshooting, then the CPI includes interest rate hikes towards the end of the period that we're looking at, and that's why you end up with the CPI up around 3%. But as always, and this translating this into monetary policy, this is then what it looks like. A repo rate with a high likelihood of staying flat until sometime next year. And then it would gradually go up towards 3%, and eventually, if everything returns to normal in the whole world, it would find its way gradually towards 4%. But still, given the time horizon that we're focusing on here, and given what's going on in the Swedish economy, the inflation rate, and what's going on around us, the policy rate will stay actually very low in a historic perspective. And in that sense, one can say that monetary policy is expansionary, and particularly if you were to translate this into kind of a real repo rate, and we're talking about a negative or very low repo rate for the foreseeable future. But as always, this is a forecast, it's not a promise, and all sorts of things, of course, can happen. We have given some thought to that in chapter 2 in the report, and included some scenarios, particularly describing what would happen, or what would happen if things turn to the worse in Europe. And then that, of course, would affect aggregate demand around us. And in that kind of a scenario, what would be most likely is that inflation would go down here as well. And then, of course, that pushes monetary policy hikes into the future, and we would end up with a lower rate of interest. But on the other hand, if nice things happen in such a way that households and corporates feel more confident about what's going on in the world, then that's likely to reduce a lot of uncertainty, will increase economic activity, and then that's likely to add to aggregate demand in one way or the other. And it would also probably increase exports, among other things. And then that, of course, would lead to more cost pressure, and interest rate hikes would come sooner rather than later. But nonetheless, the dotted line is our best forecast as of now. And as I said, this implies that the policy rate will stay flat until sometime next year, unless substantial changes happen that we can't foresee presently. So all in all, that's where we are when it comes to monetary policy. And Marianne will talk a little bit about the debt crisis in Europe and how one can think about alternative scenarios and scenarios that we have included in Chapter 2. Marianne.
Thank you. Okay. And I have a bit of a problem with my voice today. I have a cold, so excuse me if I sound a little bit different. But as Stefan said, I'm going to talk a little bit about the European debt crisis, and it's actually both of our alternative scenarios are about the European debt crisis. So I'm going to show you a couple of graphs from one of those scenarios. But first, by way of introduction, let me just say some things. In the main scenario, what do we assume about the crisis and how it's handled? Well, we assume that it will be handled, the acute phase will pass, and credible and sustainable solutions will eventually be put into place. I think you'll find those words in the report. If you've had an opportunity to read the report, you will also find that we used to say that the acute phase will pass during the fall of this year. That is no longer the assumption. Now the unease will, the acute phase will fade in 2013 instead. So there's a slight change there. So that's what we assume in the main scenario regarding how the debt crisis unfolds. But there is, of course, lots of uncertainty around that assumption. And so I'd like to talk a little bit in principle about how we handle uncertainty in the main scenario, not necessarily just uncertainty coming from the European debt crisis, but in general. How do we handle extreme events, and how do we think about the alternative scenarios? The main scenario is in principle a mean forecast. I think you've heard this before. But given the way we go about constructing our forecasts, it's a combination of judgments and models. It's terribly difficult to guarantee that this is a mean forecast in a statistical sense. Complicating matters even further, it's very easy to come up with extreme outcomes, to imagine extreme outcomes. But it's very, very difficult to assign probabilities to these extreme outcomes and to assess their likely consequences. So I think it's fair to say that extreme outcomes are not explicit parts of the forecasts, extreme outcomes. But there is, of course, sort of uncertainty that we want to illustrate, and that's what we do by the use of our alternative scenarios. When it comes to the European debt crisis, we've analyzed that, taken this as an example in our alternative scenarios on a number of occasions. At least on 4 occasions, we've had alternative scenarios that talk about the European debt crisis, and they differ in the way we look at how severe the crisis will be, how long it will take, and I'm going to talk you now through the alternative scenario, the negative scenario, and just try to point out some of the difficult issues I can't point to that, but some of the difficult issues that we have to sort of take a stand on when we model these alternative scenarios. How do we capture the financial turmoil? How should we think about it? How long will it go on? What will happen to the krona? Very important for us, a small open economy, obviously. And are there other spillovers to Sweden that we may want to take into considerations? So so the negative scenario in chapter 2 asks a question. So, what if these credible solutions do not materialize in the pace that we assume in the main scenario? What if confidence deteriorates even further? What if risk premia rise even further? Even more of a credit crunch, more strains on government finances. What would that be? How would that look? And what would the consequences be for Swedish growth, inflation, and for monetary policy? Here you can see the red dotted line is our assumption regarding growth in the euro area in the main scenario. In this alternative scenario, the blue line, we then assume that there will be a drop. Not as dramatic as the one we saw in the Lehman crisis, but it will be a prolonged period of very of negative growth. So this is one choice that we had to make when we modeled this financial turmoil. This will go on for a long time. That's what we assume here in this negative scenario. So that's the starting point of this negative scenario. There are many graphs in the report regarding this scenario. I'm going to show you 5 of those graphs. What we have to, another sort of stand we have to take is what's going to happen to the krona if this scenario materializes. Now, what we're talking about is that things take a turn for the worse in the euro area. There are strong fundamentals talking in favor of Sweden, the Swedish economy, and the Swedish krona. So you could argue for an appreciation. But here we've assumed, and in line sort of with historical experience, that instead the krona depreciates. How much? Extremely difficult to say. Here we've assumed that it depreciates 5%. Not very much compared to the Lehman crisis. But here's another difficult choice we have to make when sort of modeling the euro area crisis. But of course, and this depreciation of the krona has a very big impact on, in particular, the inflation in Sweden. So this matters a lot for how inflation reacts in Sweden. So what are the consequences for growth in Sweden if we start there? Sweden is obviously affected by the fact that there is lower export demand in Europe for Swedish products. Here we also assume that some of this financial turmoil spills over into the Swedish financial markets. Here's another channel that we have to take a stand on. How does this financial turmoil spill over into the Swedish economy? So we assume that higher risk premium, higher interest rates dampen investment and consumption. On top of that, lower confidence among firms and households can even further depress investment and consumption. And taken together, that results in a growth in Sweden being negative for 2 years in fact. Inflation reacts here very strongly to the depreciating krona. This is a rather quick pass-through. You can argue against it or for it, but this is how we've constructed this example. But as you can see, in 2014, inflation is lower, reflecting the very poor economic activity in the economy. And the last graph I'm going to show you then shows you an example of how monetary policy responds in this situation. The repo rate is lowered to in this case 0.5%. To dampen some of the effects on GDP and try to keep inflation from falling. As you saw in the slides, monetary policy was not entirely successful, so you could think of other monetary policy responses. Other paths are possible. But to sum up, when we've constructed our forecast, the main risk is the European debt crisis. It's been the main challenge when constructing our forecast, and it's been sort of the main challenge for a long time. We illustrate our uncertainty with the use of alternative scenarios, and the euro debt crisis has been at least one of those two scenarios on a number of occasions during the past years. This time it happens to be both scenarios. I've just showed you the negative one, but there's another possibility that governments do actually agree on measures in such a way that confidence returns quickly to firms and households in Europe, in which case things will look much better, and the consequences for Sweden are very favorable. And the main scenario then assumes that the crisis will be handled and the acute phase will pass, and credible and sustainable solutions will eventually be put into place.
So, to sum up, let's hope that we don't end up in that scenario, but it's there. Part of it is, of course, about technical assumptions, how you do these things when you end up being way off from whatever the average happens to be. But all in all, what we had to do this time was to weigh what's going on domestically against what's going on in the rest of the world, and that led us to the conclusion that the best way of taking Swedish monetary policy forward this time was just to stay put. So that's where we are. Reflections, comments on this?
Can I just add one more thing?
Sure.
Before, and we've written three boxes this time. One of them is on the euro debt crisis, a descriptive account of what's been happening. There's a second box on long-term developments in the labor market, and then there's a third box on the difference with the difference in inflation in Sweden versus the euro area.
So, who wants to start?
Yeah,
sure.
Your last point there with the long-term unemployment rate, is that something that's been implemented in your models now, or did you? Yeah, okay.
So we've made an update of our analysis regarding the long-term developments in the labor market, and it takes into account two things: one, new demographic projections from the Statistical Office, and the other one is the effects of the reforms instituted by the government. But we've taken those into consideration earlier, and as we write in the box, it's only very minor changes we make in our assumptions. The bottom line in that box is that there's a lot of uncertainty regarding these long-term developments. In particular, we identify an interval for the long-term unemployment range.
But have you revised it slightly upwards in either long-term unemployment level?
The interval is between 7.5, that's the upper bound, and 5.0, that's the lower bound. If you want, you could identify a midpoint in that range, and that would be 6.25, if I make my arithmetic correct. That's in line, very close to our old assumption. So there's very minor changes.
But I think one of the issues here is that one shouldn't overemphasize this whole thing about the midpoint. You can sort of arithmetically do it, but this is something that moves all the time. So it's not that it's a fixed number, and the world kind of operates around that fixed number. So in the end, it's kind of part of the general equilibrium and what's going on in the economy as a whole. So it's not that you can sort of pin it down saying, okay, now everything is determined by that particular number, and that is particularly important when you discuss monetary policy and how to weigh everything together.
No, of course it's not important today, but I mean, also in your forecast after 1-2 years, the unemployment start to go down rather quick.
Yeah, in the sense that you have, and particularly when you do the modeling, you have to make some kind of an assumption about where the whole thing is going, and that's for sure. But because that's also the way to do you do the modeling, because if you base things on some kind of a general equilibrium assumption, you have to put some numbers in there. That's for sure. But you eventually get to that stable equilibrium, that's a different matter, and that's what makes it hard.
A different question. I think it was very minor changes in your forecast overall, but it was one thing that catch my eye. It was the forecast for the EMU growth next year. You have lowered it by, I think it was 7 or 9 percentage points. Can you tell me something about that? Is it just the effects from the crisis development, or is it something else?
And the big thing is sort of the fact that these 2 steps forward and on 1 step back, it's been looking a bit favorable for a while, and the figures have come in on the low side, as you know, and confidence has dropped in the euro area. So we have lowered our forecast for next year. So it'll be, and for this year it'll be negative, slightly negative. Next year it will be slightly positive. So the euro area has 2 years with very, very poor performance. That's of course what's affecting the Swedish outlook to a great deal also.
Question regarding the repo rate path for this year. You say that the probability for lowering the rate is higher than that you are actually raising the rate. Is that how do you kind of measure that, or how do you put the probabilities on that?
If you want to construct probabilities, you can do it in a number of ways. And as you know, I mean, if you want to construct probabilities, you have to start off by defining what are the choices. So, and depending on what choices you assume, you will get different probabilities. We've chosen to describe the path in this way now, that it's more, the most likely outcome is unchanged, but there's a higher probability, if changes are made, it's more likely it's going to go down than it's going to go up. You can make other calculations, but you're going to have to make an assumption about what the possibilities are.
I have a question on the longevity of the crisis. I mean, speaking on competitiveness issues, I think you have 1.17 diagram demonstrating unit labor costs for different economies. And given that they have to do an internal evaluation, if we don't assume that breakup, shouldn't that imply that this will take much longer than a year? And shouldn't we then assume perhaps lower growth still for a longer period of time in the Euroland?
Well, it's of course hard to measure these things, because particularly if you're talking about Euroland as a whole, given that there is such disparity within Euroland itself. So that's an issue. Another issue is that in some sense we are already behind schedule if you look at what has happened in other parts of the world, when you have had a fiscal issue, when you have had an issue with the financial sector in one way or the other, because we sort of tend to forget that first time the ECB lent to banks was in 2007. That's 5 years ago. And it's very, very hard, I think, to find other cases if you look back over time when you've been at it for 5 years and you're kind of still at it, and that means that it's of course not so easy to pass judgments on how long it's going to take. While on the other hand, if you just look at kind of around us, look at the Baltic countries. I mean, you can still work your way out of these difficulties. So eventually, you're going to have a turnaround. It wouldn't surprise me if eventually you'll sort of get better numbers coming out of Ireland, Portugal. Hard to tell, but still hard to pass judgment. And it's going to take time. It's going to take time to make sure that these relative price changes actually takes time, and that's not an easy process. And it's a process which is course intertwined with everything else, but it's not a process which is the same kind of things that you do when you let's say recapitalize banks. So we'll see. But eventually you'll get a turnaround. That's for sure. I mean, history tells us that is going to happen. But we're also talking really more about relative price changes within Euroland. We're not so much talking about an issue where you'd say that the Eurozone would have very, very large imbalances towards the rest of the world, because I mean basically it's reasonably balanced. So it's more a struggle within the Eurozone itself compared to this particular episode being a substantial part of kind of global imbalances or something like that. But it doesn't make it any easier when it comes to making projections. That's for sure.
But in that perspective, Sweden are relatively well placed, of course. I mean, one part of that change is that Germany increases their costs. That also have a positive effect for Swedish manufacturers.
Yeah. I mean, eventually this thing has to balance out, and everybody can't be better than average. So, I mean, some have to go up and others have to go down, and that's just the way it's going to happen. But within what time frame, of course, very difficult to say. We have our own history from the 70s and the 80s, and it took us 20 years to engineer the imbalances that we had back then, and then it took us another 10 years to kind of get back on track in terms of correcting many things over this entire time period. And it took us also, I think, almost 10 years to get back our AAA rating. So the lesson is basically that if you end up with a serious macroeconomic disequilibrium, then it just takes time to put the pieces back together. But then, of course, if you look at the Eurozone as a whole, we're talking about individual countries, and Germany is reasonably okay. So in that sense, the average numbers will always be better for the zone as a whole compared to individual countries.
One important factor behind your decision today was that the labor market has surprised positively at the start of this year. Employment, working hours, much better than your previous forecast. Have you done any underlying analysis regarding what really has happened? Why have the labor market performed better than? What's your view?
Okay. No, you're right. I mean, fortunately, both unemployment and labor participation have turned out better than feared, than we expected in April. I don't have an in-depth analysis of why that is so. And we've changed our forecasts accordingly. Our forecast for unemployment is now slightly lower than it used to be, and unemployment is gonna go up to about 7.8%, we believe, around about the first quarter of next year. But we made forecast errors on the good side, so to speak.
Any questions for those who are listening in? Okay, if not,
Final question regarding
sure.
that. You've seen productivity growth be quite dismal, though. So maybe that's the somewhat explanation to.
Yeah, I mean that could be part of it, but these are very, very difficult forecasts to make also. So I mean that could be part of it.
Change in the labor force or change in the service sector, underlying
I mean those factors are important to take into consideration when looking at long-term changes in unemployment in particular. But now we're looking at sort of you asked me about sort of individual months. Why did why have things not turned out quite in the way we expected? I think it's too early to draw any definite conclusions there.
Sometimes short-term and long-term can coincide.
Definitely, yeah, sure.
Okay, on this beautiful Wednesday afternoon, thank you for coming, thank you for listening in, and thank you for watching. To all of you, have a nice summer, and we'll start over again in September. Thanks.